The end of the year is a great time to look at your budget and figure out, hey, do I have room in my budget to dial up my savings a little bit in January when those new limits go into effect? Is there anything I can cut out of my spending? Just make sure you have a plan. If you're catching up to FI, you want to be doing what you can to try to max out those accounts. And so it's a great end of the year strategy that I would say is worth doing.
Make sure you understand your benefits. Don't lose out on the savings you get from what the employer, that's part of your pay. And if you're not maximizing your benefits, you're leaving money on the table, not just the 401k match, right?
100% right. Yep. We'll have clients that leave their W-2 job and to go start their own business or do consulting work, and they'll sometimes ask us to value how much their benefits were worth to them that they're kind of giving up. And on average, we're finding it's about 20% of pay. So if somebody makes 100 grand, the benefits are worth $20,000 when you factor in employer 401k match. So if you are someone that has the cash flow to max out your 401k, which if you're trying to catch up to FI, that's a great strategy. Just make sure in the end of the year timeframe, when you still have a couple paychecks left, run the math, make sure you're on track to max out if that was your intention. So you really just look at how much have you contributed year to date, how many more paychecks are left, are you going to hit that limit? And don't worry about going over the limit. I think this is really important.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. We have with us Eric Simonson, but before we introduce him, I want to read such a lovely podcast review that really warms our hearts and keeps us going. Right, Jackie?
That is right, and I love this one.
Okay, well, this is from Graceful Investing, or Just Me, Jody C. And it's a 5-star review, which we love from our audience, and we love it when you write them because it gets the message out to others. She says, "This podcast is so great. I was ready to start my own as I couldn't find a podcast that spoke to the late starters such as myself. Then I stumbled across this amazing podcast where I see that I'm not alone. There's a way to financial freedom, even if we didn't start at 25. Thank you for providing great content and reminding us late starters to give ourselves grace in our journey. Keep up the great work." Okay, Jackie, I'm all charged up already, ready to jump into the show.
I am too. That just warms our hearts, All
right, well, let's introduce Eric. He's been a sponsor of the show through Abundo Wealth, and we're very appreciative of that. And today we get to have him on to talk about year-end tips for financial thoroughness and make sure you got your ducks in a row at the end of the financial season. Eric Simonson, CFP, is the founder and CEO of Abundo Wealth, a FI-friendly, advice-only financial planning firm. He's on a mission to help as many people as he can with high-quality, conflict-free, comprehensive financial planning with an education-first mindset. After working as a traditional advisor for over a decade, Eric saw a need to help people who couldn't work with a traditional financial advisor since most require having a minimum amount of money to invest with them first. In 2019, Eric left his corporate job and launched a different model, one where he was only paid for giving honest advice that benefited his clients, not the advisor. He built Abundo around a transparent, flat monthly fee and advice-only model, eliminating conflicts of interest without overcharging for professional advice and using proven low-cost investments. His growing firm now provides guidance to over 500 households in all areas of their financial lives. One unique service the firm offers even is travel hacking. They love teaching these skills to their clients. They can offer guidance on various aspects of travel, such as budgeting for trips, finding cost-effective travel options, and maximizing travel rewards programs. Abundo is a disruptor, and they're truly changing the game. Eric is also passionate as a foodie and an aspiring yogi. As an avid traveler, chances are you'll find him in Italy, Hawaii, Argentina, or anywhere other than his home in Houston. He's also a travel hacking expert, as we mentioned. Eric, it is a pleasure to welcome you to Catching Up to FI.
Thank you, Bill. Thank you, Jackie. I really appreciate you having me on.
Oh, we're glad to have you. So now yogi, I'm sorry. Tell us what yogi is and what's that about?
Yeah, I think yogi is really in the eye of the beholder. For me, it just means meditating regularly. It means being mindful of what is happening on a day-to-day basis, being appreciative, being grateful. That to me is being a yogi. It's not on my mat with in down dog position. That you'll never see me doing. I'm more in the spiritual, mental aspect of it.
Holistic approach to life, as well as your holistic approach and comprehensive life planning approach, I'd refer to it as a financial advisor, which I think is really the way of the future. It's not just about the numbers, it's about the holistic mindset, the yogi, the Zen in finances, and people like you, and it's a growing number, take care of their clients in ways that people are not traditionally used to, right?
Yeah, that's exactly right. It always has baffled my mind because I view financial planning as advice on finances in all aspects of finances. And I think most financial advisors and what most people perceive a financial advisor as being as somebody who just does investment management. And that I feel like that's always been a big disconnect. And so we're trying to prove to the world that look, a good financial planner, a good financial advisor is somebody that's going to it doesn't matter how big, how small your financial question, right? They want to be there to help you and support you. And yeah, I think there is a lot of parallels to that and mindfulness and that yogi nature that I aspire to be.
Yeah, and we have to talk about how we met Eric. So we had Chris Mamula on the show, who is my FI friend from the FIRE movement. We actually took our CFP exam the same year. So he works for Abundo. He is one of the authors of the CUtFI book. I think is your blueprint to financial independence.
Yep.
Yeah. So when I heard that he was working with your firm, I'm like, oh, if my FI friend Chris is working there, they must be doing something different because we have very similar, I guess, views on the financial planning industry that's kind of the same. And sometimes we're not so proud of what we see with a lot of the assets under management and things like that. So it's refreshing to see this different approach. Not a lot of people doing it that way, but you are. And that's why we wanted to kind of bring you on and to speak to this great article that was written. It's a checklist for must do's at the end of the year. Now, someone else at your firm actually wrote this. Was it Jeremy Zook that wrote this?
Yeah, I'm glad you pointed that out. Yeah, this was written by Jeremy Zucchi, one of our amazing financial planners on the team. Jeremy is also very much a financial independence guy, just like Chris on the team.
Yeah, and I know him too. I got to know him. So when he told me he was working, so I just feel like there's not a lot of firms, and I used to think this a lot too, that really are kind of serving the financial independence community. And I'm just really glad to see that because we're very selective with who we bring on the show because I know what the industry mostly is.
Mm-hmm.
And I'm like, who are the unicorns that are FI friendly and in the FI space? And you're one of them. So it was a well-written article. And we're like, it is so timely for us to go through this. And you so kindly agreed to come on the show and to help us through this and to help all of our audience as well.
Yeah, absolutely. Year-end checklist is something that I think is so important that all advisors here at Abundo, we make sure that whenever possible, we're talking to clients about this list. So I'm excited to kind of dig into it with you guys.
All right, well, let's jump in because there's 7 items and they're robust. The first one on the list is check your retirement plan contributions. That's actually number 1. So take us through why it's number 1 and what you mean by that.
You're right. We have 7 on the list. I came with 2 bonus, catching up to FI bonus year-end checklist items. So we're going to have 9 for you if you guys don't mind. But first thing is checking your retirement plan contributions. So if you are someone that has the cash flow to max out your 401k, which if you're trying to catch up to FI, that's a great strategy. Just make sure in the end of the year timeframe, when you still have a couple paychecks left, run the math, make sure you're on track to max out if that was your intention. So you really just look at how much have you contributed year to date, how many more paychecks are left, are you going to hit that limit? And don't worry about going over the limit. I think this is really important because almost all payroll providers will cut you off when you hit the 401k max for your age. And so be aggressive with it, try to max out, but just, make sure that if you've got a little room left, now's the time to bump it up.
These are for W-2 jobs largely and traditional 401ks. I'm in a solo 401k and it's a little different for maxing out that vehicle, right?
It is, yeah. Solo K, you actually have until the tax deadline of the following year, so April 15th, to max out the solo 401k. So a little bit more flexibility on that. If you're self-employed and you're choosing to do a SEP IRA or solo 401k, then yeah, it's not quite the pressing year-end checklist item as it otherwise would be.
So, Eric, I got a quick question because I have a December birthday. So I think some people you've got where you can do the catch-up contributions at age 50. And as long as you're age 50 by December 31st of that year, you get to put in the catch-up, correct?
That is correct. It's one of the advantages of having a December birthday. Yeah, absolutely. If you find yourself hitting 50 in the current calendar year, your max is actually higher than what it otherwise would have been.
There's also a big superpower, sort of a super catch up for those starting next year, I believe, between 60 and 63, which I was really pleased to see. So you've got the 50-year-old and on catch up, but now we have something different. Can you go through that for us?
Oh, gosh, you're putting me on a spot. I know of it, Bill. I haven't looked at it. I think I would be doing your readers or your listeners a disservice if I tried to guess what it was. I think it's $5,000 more, but I don't know.
I got your back, man. It's the greater of $10,000 or 10% of the catch-up contribution.
We will add the link to the show notes because that is good to know because there's laws change around this stuff all of the time. So we'll put the exact number in the show notes so that you're clear on that. But one thing I wanted to mention as we're talking about retirement accounts, now these are employer-sponsored plans, 401k, 403b, thrift savings plan, things like that. But for IRAs, that's different, right?
Correct. Yeah. IRAs, Jackie, are going to work very similar to how Bill's solo 401k example works, where you actually have until the tax deadline to contribute to the Roth IRA or traditional IRA if you choose to do so. Similar to HSAs as well. HSAs, you also have the tax deadline. Most people contribute to an HSA through their paycheck, which does make more sense because you actually save a little bit on taxes if you do it that way. If you're doing the HSA savings through the paycheck, then you do have the calendar deadline end of the year. But if you're doing it outside the payroll, then you can contribute up until April 15th.
Right. So if they can't do it through their employer and they need to catch up, they can make the contributions themselves and then they'll have to do something on their tax return. I think I had to do that one year because I didn't realize till the last minute, but that's a good one. Or I guess with the HSA, I had until tax filing deadline for that. Okay, so that makes sense.
Well, there's one more thing too that I didn't realize initially was this is a use it or lose it. I mean, this is a space with your 401k or your IRA that unless you take care of it in the calendar year or by tax time for certain accounts, you don't get it back. It doesn't roll over.
100% right. Yeah, that's a great way of looking at it. I know with Roth IRAs, that is language I've used before with clients where, because that's such a relatively small contribution limit that do everything you can to try to maximize that each year. But 401k, HSA, yeah, absolutely the same idea that you have 1 year to get it in and then a new limit starts.
Now, there's also, you got to look at your plan, you got to read it because we haven't touched on it yet, the mega backdoor Roth. Can you take us through what that is and if your plan has it, how you can take advantage of it?
Yeah, I can. Mega backdoor Roth, we're seeing in maybe 1 out of every 5 or so employer plans. So it's not that common, but it's still common enough that you might find yourself being eligible for it. So the way you'll know is if you look at your 401k and you've got 3 different contribution options. You've got your regular traditional 401k, you've got the Roth 401k, and those 2 are in most 401ks, right? But where it gets special is if you also have a third option, which is the after-tax 401k. If you see that, that opens your ability up to do the mega backdoor Roth. And so what people who have that available to them, what they do is they'll usually max out the regular 401k, so the traditional or Roth portion, but then on top of that, they'll also contribute either $10,000 or 10% of their income, a certain amount to this after-tax portion of the 401k. And it's important to note that that after-tax portion doesn't have the same annual contribution limit as the pre-tax and the Roth 401k does. Meaning if you contribute to the after-tax 401k, you can actually go above and beyond that $23,000 or so contribution limit. So you put money into the after-tax 401k, And then once a year, you're actually allowed to withdraw money from the after-tax 401k and contribute it or roll it directly into your Roth IRA. So, for example, if you put $10,000 in your after-tax 401k, you could withdraw $10,000, plunk it into your Roth. That is a higher funding amount than you otherwise would have been able to put into your Roth. So that's a really great aspect. And then also you don't have the same income restrictions to contribute to the after-tax 401k or the mega backdoor Roth IRA that you would with just a regular Roth IRA contribution.
Yeah, and I did try that maneuver once. I think it's kind of like a high income earners play because you have to have enough dollars to be able to max out your regular 401k and do these extra money. Have you ever done the backdoor Roth, Bill?
No, my plan doesn't allow for it. I'm with Fidelity.
Oh.
It's a plan that doesn't allow, and I don't miss it really because, as Sean Mullaney has said to us before, late starters probably are best off contributing to their traditional 401k.
Yeah. And well, this is above and beyond the limit that you can put in your 401k, correct, Eric?
Yeah, so if you start contributing to the after tax, then the limit that you really bring into play is kind of your full retirement plan contribution limit, which is 69,000 this year, I believe. And so that means that between the pre-tax or Roth 401k plus the employer match plus your after-tax 401k contribution, you have that full $69,000 limit. So we've had some clients actually put as much as like $30,000, $35,000 into an after-tax 401k. So if you have the cash flow to do it and your plan offers it, it can be tremendously valuable, but it's kind of like a unicorn. Your plan is making a lot of income, but yeah, it's a cool strategy if it works for you.
Yeah, my plan doesn't offer it, but I have the employer match of the solo 401k where I get the $69,000 total between employee employer and then the catch-up contribution. And as a doctor, assumedly, if I'm making the gap like a lot of doctors don't, I can max it out to the tune of, I think, $74,500 or something along those lines.
Yeah, the solo K is great for that purpose too.
So, Eric, let's talk about flexible spending account dollars. And I purposely spell that out, flexible spending account, because it always gets confused with a health savings account, an HSA, but very different when it comes to end of the year planning. Talk to us about that.
Yep. So health savings accounts, HSAs, you can contribute to it and those dollars can be invested. Those dollars can grow forever, theoretically, until you're retired. However, FSAs, flexible spending account dollars, have to be depleted by the end of the year. Otherwise, you lose it. There is a small amount, I think it's $640 this year that you can roll into the next year. But any dollars above that, if you put $2,000 in your FSA and you didn't use any of it, $1,300+ of it would be at risk of being forfeited. So if you're going to contribute to like a medical FSA, very important to not put in more than you're pretty confident you're going to use. And if you do have dollars in your FSA, end of the year is the time to look at using them if you haven't already. So can you purchase prescription drugs? I was talking to one of our advisors today and they were talking about buying like stocking stuffers, like chapstick and whatnot with FSA dollars. That's an eligible expense.
That's a good reminder of all the things that you can buy with your FSA. You can get over-the-counter medical supplies or medicines and things like that, right?
Exactly. Yep. Contacts, some dental work.
Cough medicine, bandages, all of that stuff. So it's much easier to spend it down because I think there was a window where over-the-counter stuff was not an eligible expense for FSAs or HSAs.
Yeah, I think you're right. I don't remember how many years ago. I think it might have been, I don't know, 5-6 years ago, they made a change with that to make them more flexible.
Right, which I'm glad. Now, when we talk about FSAs, this includes all types like dependent care FSA, there's commuter FSA, like there's some non-medical FSAs. They would work the same.
Right. Lose it or use it. Just to make sure you have a plan with the dependent care FSA, you're reimbursing yourself for any childcare or daycare related costs that you incurred for the year. Very important to circle the FSA and say, I got to get these dollars out of the account. Yeah. But again, to be clear, not the same rules with the HSA. Those are going to be continue to carry forward.
Questions from my end. I don't have access to this as a solopreneur, but I would encourage all people that have kids, because it's easy to max this out. When we had young kids, you're going to the pediatrician, you're getting immunizations, and those dollars went away. Get your colonoscopy, get your mammogram. There are some routine healthcare things that may not be covered by insurance fully that you can do prophylactic medical care, or get your routine annual physical. These are all things that add up pretty quickly. And as a physician, I have to promote these things. The question I have for this, though, you can't invest it. Right? Does this account earn any interest? Is there any growth possible? Or is it just cash sitting there that you could self-insure for this and have it in a high yield savings account and just put $3,000 a year in one of these? So is it really valuable? Or if for growth, do you get matches from your employer, for example?
Yeah, the value really comes in the tax benefits of funneling money through this account. So for like the dependent care FSA, it essentially allows you to pay for $5,000 of dependent care pre-tax. So you don't have to pay taxes on that income if it funnels through the FSA. That's really the kind of the big reason why people use these plans. Because you're right, to your point, it's not going to grow. It's not going to be invested. It's a pass-through account.
And Eric, these flexible spending accounts, they are owned by the employer, not you. You can't take it with you. At the end of the year, if you don't use it, it just goes back to the employer, whatever. Is that right? And that's another big difference in that and the HSA.
Yeah, that is my understanding as well, Jackie. And so that's why you always want to have a plan to get those dollars back as quick as possible. That's why I really call it like a pass-through account. It's an account you put money into and you take money out kind of in a circular manner. It's not meant to be used as an accumulation tool.
Yeah, and one of the things basically based on this is make sure you understand your benefits. Don't lose out on the savings you get from what the employer, that's part of your pay. And if you're not maximizing your benefits, you're leaving money on the table, not just the 401k match, right?
100% right. Yep. We'll have clients that leave their W-2 job and to go start their own business or do consulting work. And they'll sometimes ask us to value how much their benefits were worth to them that they're kind of giving up. And on average, we're finding it's about 20% of pay. So if somebody makes 100 grand, the benefits are worth $20,000 when you factor in employer 401k match, maybe HSA match, offering life insurance, disability insurance. It's sometimes hard to quantify all of it, but it's very meaningful for sure.
Jackie, let's pause for a minute. And before we continue, let's share some words about one of this week's sponsors, Delete Me.
Yeah, the latest report from the Federal Trade Commission showed that in 2023, $10 billion was lost to consumer fraud, and $2.7 billion of that was lost to imposter scams.
Yeah, they've tried to scam me. They've scammed my mother. This is a real problem. So what do you do about it? Well, first off, just learning more about the tactics these scammers use can help us know what to look out for. But in a big way, I try to keep our family protected is to make sure that all of our personal information is removed from as many data broker websites as possible so that we're less enticing of a target.
Yeah, you'd be shocked at how many sites out there are sharing your address, phone number, birthday, email, and a lot more. But fortunately, you can get these data brokers to remove your information. But unfortunately, the process takes hours and hours to do it by yourself.
I know, because I tried to contact them, and only after spending 10 hours did I give up and start using Delete Me, our sponsor today. So take control of your data and keep your private life private by signing up for Delete Me. Now at a special discount for our listeners, just go to joindeleteme.com/catching up. That's joindeleteme.com/catching up. You'll find the link in our show notes.
Why don't we talk a little about the next one? Number 3 is charitable donations. How important is that?
Yeah, this is actually probably my favorite one on the list. So I really enjoy talking about this with folks. So this time of year, fall, around Thanksgiving, a lot of employers offer a matching program where if you contribute to charity, they'll contribute as well on your behalf. So it's always good to look at this at the end of the year. And there's a lot of ways to kind of give money to charity. And I would say the first thing to be aware of is the rules are always changing with how charitable donations are factored from a tax perspective. But now in 2024, the way it works is you have to be able to itemize your deductions in order to deduct charitable contributions. So work with your CPA, find out how much money would you have to give in order to actually be able to write it off, if that's important to you. If it's not important to you and you want to give, great. But just number one, make sure, first of all, it's going to be a tax deduction. Second thing would be if you have highly appreciated investments, which a lot of folks probably do this year because it's been a really great year in the market, it usually makes a lot more financial sense to actually gift stock or give shares of the index investment to the charity versus doing cash. Because if you do it that way, let's say you have a Vanguard Total Market Index and it's up 30% this year, and you want to give 5 shares of the Vanguard Total Market Index to the charity, they don't have to pay taxes on it. You don't have to pay taxes on it. And what that does is that saves you from eventually having to pay capital gains on that contribution, because nobody pays capital gains on it if you give it to a charity. So it's kind of a cool deal that works. And it's not that hard to do. I think sometimes people get worried about that. It seems harder than it is, but most charities are set up to accept stock, and there's just a form that you fill out. And that's oftentimes what we'll recommend at the end of the year.
Yeah. And when you're retired, for example, you have QCDs that are also a leverage on getting rid of the taxes and the growth. Briefly, not a lot of our audience is retired, but briefly tell us they can look forward to this. And this is another way to limit your required minimum distributions.
Right. If you're age eligible to access IRA, then you would do what's called a qualified charitable distribution donation, where you're basically moving money directly from your IRA to a charity, and that can actually satisfy your required minimum distribution, and it can avoid taxes on, well, actually, no, this is something we do with all of our clients either, but I think you still pay taxes on the distribution, but I'd have to look that up. Do you know, top of your head?
I'm pretty sure it's a way to avoid the tax on both ends for you and the organization.
That would make sense, just like the capital gain with gifting stock.
Well, I was going to say, Bill, are you doing that?
I'm not there yet when I am required to take them at 73, but there's another way of doing this. If you batch you don't have to do it annually. I mean, I would recommend not doing it in cash because you got the credit card fees and not all the money you donate is going through to the organization, and vet the organization because they may have a lot of overhead and you want to have impact giving. But one of the ways we did this was to donate appreciated shares to a donor advised fund. And I'm a big fan. Fidelity has a low minimum. Vanguard, for example, has a $25,000 minimum, which is for a lot of people unapproachable. But Fidelity, I believe, is a $5,000 minimum. So if you're going to give $5,000 away, donate it to Fidelity, and then you can use that and donate to any nonprofit, and you have growth.
Yeah. And then if you did, let's say, a big amount in 1 year, it would allow you to hopefully itemize that donation or itemize your deductions, and then you distribute it from the donor advised fund over the next couple of years, and then you do it again. So it's a way to hopefully get also more tax benefits from it than just doing a smaller amount each year.
Well, the problem we have with charitable donations is that we have a large standard deduction of, say, 29.5 or something like that. So it's hard to get to the point of itemization.
Yep.
Yeah. And Eric, I was glad that you mentioned a lot of companies will match your donations. And usually that does cut off at the end of the year. My company did that. If you donated $500, they would match up to $500. And then some companies even will let you take a volunteer day where you'll get paid where you normally get paid, and you can volunteer in the community. And that normally will cut off by the end of the year. So I'm glad you mentioned that. So that's for all of our working audience. That's a benefit sometimes we overlook.
Absolutely. Yeah.
Yeah. So what's our next one, Bill?
The next one, number 4, is contribute to your 529 account. So don't forget this. College education has gotten super expensive, and you got to be judicious with this. But why do you recommend relooking at this at the end of the year?
Yeah, this isn't as obvious as a year-end thing as the other ones, but a couple of reasons. One, it's around the holidays. There's oftentimes gifts that people get, and it's nice to remember that you can quickly just funnel those into the 529 for your child. So there's usually even a gift QR code that 529 plans will give you. So if you want to say, hey, for my son's birthday, right, here's his 529 QR code, you can do that. And so it's kind of a nice way to help boost savings a bit more. But then the other big thing kind of with year end is really just part of being fiscally responsible. And if you have a child, you have a goal to save up for their college expenses, looking at this account at the end of the year and saying, hey, did I contribute to my goal amount? And if not, there's a little opportunity, a little more window left to add in maybe year-end bonus dollars, or with the Social Security wage base. If you're a high income earner and your Social Security wage base has kind of been maxed out and your cash flow is now higher for the last couple of months of the year, you could turn around and fund that into the 529 account, for example. So those are the reasons why we like to talk about it at the end of the year.
And if you get a windfall, for example, a fortunate or unfortunate windfall, you can max out the charitable giving amount, which I think is what, $18,000 now, where you can take part or all of that windfall and front load your 529, right?
Yeah, I was just looking at this actually last night for a client. If you're a married couple, I think it's $180,000 that you could put into a 529 plan in 1 year and stay under the gifting limits, which is a lot. I mean, that would be a huge contribution to a 529 plan. But yeah, they're unique. Those plans are unique in that they offer a kind of a super gift ability with the 5-year kind of gifting rule.
And with the 529, Eric, you create a generational educational fund that gets handed down through generations too, right?
Well, exactly. Yeah, 529 plans, just like Jackie was talking about with FSAs, 529 plans have gotten more flexible. There's more ways to use them now. You can use them for K through 12 expenses. You can use them for room and board in college. You can use them for grad school. You can transfer them to grandkids. You can transfer them to other children. So I don't want to say it's impossible to kind of not use up the 529 plan, but there's definitely a lot of ways to use the 529.
And there was a new law that happened that they put some restrictions around it, but where if you have leftover money in a 529, you can use it as a funding source for Roth IRA. So what another sort of legacy building. Mm-hmm. I think that will help a lot of people out, because some people are like, well, what if I don't use the money? What if my kid doesn't go to school? Or what if they get a scholarship and I don't need the money? There's options for them now, right?
Yeah, that came out, I think it was 2023. And yeah, that we just started looking at that with a few clients. It's interesting. So the rules are, if you have a 529 plan that, let's say, didn't get used up, you can transfer it to a Roth IRA as long as the account had been open for 15 years. And importantly, you're transferring it to a Roth IRA of the beneficiary. So it's not going to like the parent. It would be like the kid. So that's still fine. It's still great. It's a great thing for that child. But yeah, I know a lot of parents try to put money in Roth IRAs and help their kids that way for them. So that could be a good backup. If you want to do that in 15, 20 years after that kid's out of school, absolutely don't worry about the amount. There's a limit. I think it's $30,000 that you can in total do to maybe it's 32, 35, somewhere around there of rollover, but it's still not nothing.
That's a way to supercharge a Roth IRA. That's a
great way to do it.
That's a huge contribution. So that leftover 529, good idea to think about that, and don't forget about it. Yes. All right, Jackie, we got several more to get through, and we got two special ones for our late starter audience that I want to get to. So let's keep rolling.
Okay, the next one, let's talk about number 5, which is Roth IRA conversions.
Yes, Roth IRA conversion. So if you are in a low tax bracket or you expect to be in a higher tax bracket in the future, it's always great to look at, does it make sense to take any money from a traditional IRA and convert it to a Roth? And it's a good thing to do at the end of the year because you have a really good idea of how your income is going to end up that year. If you did it in January, like so many things could happen. So doing it at the end of the year makes sense. And I would say work with your tax advisor on this, but most of the time what people do is they look at what tax bracket they're in. They look at how much room is left in that tax bracket, and then they try to do a conversion amount to kind of fill up that bracket. You don't want to bump yourself into a much higher tax bracket by doing this, but if you have room in a low tax bracket, it's good to take advantage of that and shifting money into a Roth.
So, Eric, I made a mistake with this one time. Roth conversion specifically, you should always wait toward the end of the year, because if you don't, you may not know what your income looks like, especially if you're no longer W-2. So I made the mistake a couple years ago of doing a Roth conversion in March. And that was a big mistake because that year I ended up having a lot more income than I thought. So looking at this at the end of the year is much better than doing it earlier in the year. And I learned that from experience.
100%. Yeah, you're not the only one, I'm sure, Jackie.
Okay.
And one of the things you got to be careful of, because I do a backdoor Roth, is the pro rata rule. And if you could explain that and why you need to have a zero balance in your traditional IRA in order to fully take advantage of the backdoor Roth.
Yeah, I don't want to get too technical here for the listeners, but to your point, Bill, you want to make sure if you're doing a backdoor Roth, the traditional IRA portion of the backdoor that you put money into and then you converted that to a Roth, you just want to make sure there's no residual dollars left in the traditional IRA at the end of the year. Because if there are, then the IRS is going to deem that conversion that you did partially taxable. That's going to require you to start tracking your basis moving forward and really just creates more of a tax headache for you than anything else. So if there's money in the IRA, you want to clear it out to just keep things really clean and really easily trackable from a tax perspective.
Another thing that I think is important, if you have the bandwidth and the cash flow and you get ahead of yourself and you pre-save for things like your Roth IRA, your HSA, even your 529, time in the market is valuable. So if you lump sum these things in January, you get 12 more months of growth.
Yeah, almost all of our clients who do lump sum Roth or do the lump sum backdoor Roth, we're doing it first part of the year for that reason.
Yeah, let's talk a little bit about the next one, which is tax loss harvesting and tax gain harvesting.
Yes. So in kind of normal market years, it makes sense to look at your investments at the end of the year and identify, hey, do I have anything that's down? And this year, almost everything is up. So we don't really have that opportunity to do any tax loss selling. But if you did look and use, maybe you had some individual stocks that you invested in that did poorly, it's great to try to trim those. And if the loss that you take is $3,000, you can actually use up to $3,000 to offset your income for that year. If the loss is greater than that, then that actually carries forward and either offsets capital gains that have been incurred or future capital gains or future income. So always make sure you take advantage of those losers, if you will, in that year. Also, on the flip side, if you have big gainers, sometimes it makes sense. Maybe you are between jobs that year or you had a really low income year unexpectedly. There might be a chance for you to actually generate some capital gains at the 0% tax bracket. We don't see this super commonly, but when you can do it, it's like unbelievable. It's a great strategy. So yeah, maybe if you're in your first couple of years of retirement, your income is really, really low, you're living off of Roth investments or savings. Yeah, thinking about that. Hey, is there any income I can, or any capital gains I can generate at 0%?
Yeah, and I also wanted to clarify, Eric. So this is for brokerage accounts only. This is not for retirement accounts. That's completely different. So these are for the taxable brokerage accounts only that you can take advantage of some of these provisions, right?
Yeah, thank you, Jackie, for clarifying that. I know your readers are just all so smart and sophisticated. I assume that was clear, but you're right. Roth IRAs, traditional IRAs, 401ks, those are all tax deferred. You don't have the same rules. This would just be your after-tax brokerage account.
And one of the things you got to be careful of, and this may be too technical a little bit, but read up about it when we mention the terms, you got to avoid the wash rule. When you sell these things, you've got 31 days to buy them back if you want to buy them back. But if you want to keep the money in the market, you have to buy an equivalent but not identical fund. So for example, you wanted to tax loss harvest in your growth funds or your total US stock funds. You could sell your VTSAX and buy the S&P 500 and you won't incur this wash rule.
Right. Yep. Great points. And I do find it interesting that when you're doing index investing, which we recommend for our clients and which I know a lot of your listeners do, it's a little easier to get around those wash sale rules because you can still be invested in the index in a different way versus if you had just invested in a stock and you had to sell that.
Yeah. And can you give us a quick, clear definition of what the wash sale rule is, Eric?
Yeah, the IRS doesn't want you to just sell your Facebook stock and take a loss and then the next day buy it back with at a clean slate. And they're saying it was clear to us that you sold that investment just for purposes of the tax loss. And so they put this restriction saying you have to stay away from the investment for at least 31 days. Otherwise, we're going to disallow the loss. But to what Bill was saying, if you were investing in the Fidelity Total Market Index, you sell it, but you turn around, you go invest in SPY, which effectively are going to track very similarly, but they're not going to view that as the same investment. They'll allow you to kind of buy it quickly after selling the total market index.
One of the things you got to watch here too is you're not selling the whole fund. And this is where you got to sell lots. You want to use something called spec ID or specific ID, where the last time you bought may be time where you have a 10% correction and you took an immediate loss in the stock. That's a time where you can tax loss harvest and let the government pay with their $3,000 ordinary tax income part of your loss.
Right. Yeah, you're right. If you're doing partial shares, if you have a big investment, you have to be really careful with that. We have an advisor on our team that is the expert on that I always go to for questions about that. But yeah, most of the time when we're initiating this with clients, it's usually kind of a wholesale sell, wholesale buy. But yeah, if you're selling specific lots just to get the $3,000 loss, for example, definitely know what you're doing and know what shares you're actually selling.
Man, we really got the smart Bill on the podcast today. He's throwing out all these technical questions. He's on it, man.
Well, we're trying to spark our audience to dive deeper into this stuff. They may not understand
That's
it
true.
the first time, but listen the second time, take the terms, Google them. And these are all things that are important to know and enhancing your financial literacy language.
Yeah.
All right, we got 3 more to get through, Jackie, and I think we got time for them.
Yeah, let's do number 7 really quick because this doesn't apply to a lot of our audience, but it's talking about required minimum distributions. I want our audience to think about their older relatives, their parents or their grandparents or somebody like that. So talk us through why looking at required minimum distributions is important.
Yeah, so biggest reason is just if you don't take the required minimum distribution, there's a really substantially high penalty that you pay. It used to be worse. It's gotten a little bit better after Secure 2.0, but it's one of the more penalizing kind of mistakes that somebody can make, and also one of the more easily avoidable mistakes, right? It's not that hard to take the required minimum distribution. So just make sure you're doing that. If you've got a ton of IRAs, you don't have to take a required minimum distribution from each one. You can take the full distribution from one of the accounts, for example, which sometimes people are surprised by. So that's why I mention it. But yeah, there's a bunch of RMD calculators out there that you can find. And your broker will also let you know what your required minimum distribution is for that account you have with them as well.
The first year you do this, you have until tax time to do it. You get a little grace period because it's the first year you turn 73 now. But the next year's, this is again something you got to do by the end of the year to avoid the penalty. All right, Jackie, this is where we get to the 2 that he brought on that aren't on our list.
The bonuses.
The bonus. Yeah, the late starter bonus. We love it.
Yeah, so the first one is if you found yourself going to the doctor a lot and incurred a lot of medical expenses throughout the year, you might be at your full kind of deductible, your full insurance max for the year. If so, go do all those things you need to do for your health. It happens more often than you would guess that somebody hits their deductible for an unforeseen circumstance and they've got half the year, a quarter of the year to go and get different medical things done. So take a look at your plan, just know how close you are to that. And if you do have the ability to get some free medical work done, I would say end of the year is a great time to do that.
Yeah, that's happened to us this year because my wife had a significant health issue this year, and I'm bugging her to get her colonoscopy before the end of the year.
Oh, that's sexy.
Yeah, go to the dermatologist, go to the dentist, go everywhere. And the problem is, though, that's with the last quarter of the year. I know as a physician, everybody's busy. So you got to plan for these things in advance because you may not get the appointment before the end of the year.
That's a great point. Yep.
What's our other bonus?
Yeah, last thing, and this one is, I think it's fun. And that is, Bill mentioned earlier about the new 401k limits that are going to affect next year. And what I would say is a lot of different savings vehicles increase in contribution amounts every year. So 401ks, HSAs, Roth, they tick up a little bit. And so the end of the year is a great time to look at your budget and figure out, hey, do I have room in my budget to dial up my savings a little bit in January when those new limits go into effect? Is there anything I can cut out of my spending? Just make sure you have a plan, because if you're catching up to FI, you want to be doing what you can to try to max out those accounts. And so it's a great end of the year strategy that I would say is worth doing.
Since I dollar cost average into escrow accounts the year prior to my Roth IRA, my backdoor Roth, and my HSA, you've got to watch for that so you can tick up your monthly amount that you're saving for yourself to lump sum it in the next year. And then I've got to watch my solo 401k because, yeah, those maxes go up, and I may reach the point where I can't max them out because I don't have the cash flow. But you got to pay attention to that, especially this new rule between 60 and 63 for those that have the cash flow, and if you're catching up to 5. So I agree, but pay attention.
Yeah, that's a really good point to make sure you're looking at, because if your intention is to max out your 401k and you're not looking at these increases every year as the IRS increase the limits, then you could, even if you're intending to max it out, you may not be maxing it out if you didn't change your percentage. Like if you were 22% and then the IRS upped the amount, and you didn't up it, maybe it should be 24% now. So yeah, that's a good point and something I don't think I was doing.
Oh, and you got to make sure so you don't get a tax bomb that you look at your withholding on your W-2 as well, because your income goes up and you may need to up what you save as a percentage so that you don't get hit at tax time with, oh my God, I owe the IRS something.
Yeah, that would be hard to make a change at the end of the year for tax withholding, but definitely going into January, making sure if you got a big income increase, that would be kind of a Q1 checklist item for me, is take a look at your withholdings and make sure you project it out for the year and it's on the right track.
Well, Jackie, this has been a great end of year list. So Merry Christmas, everybody. It's coming fast. Make sure you pre-save for all those gifts so you're not flexing the credit cards and come up with a big bill in January. Again, something you got to plan for. And I have a sinking fund for that. So at any rate, Eric, this has been a pleasure. It's great to have you on the show. I want to direct everybody, if they want to find out more about the Abundo business model as a disruptor in the fiduciary advice only financial planning space, please listen to episode 376 of the Financial Advisor Success Podcast with the eminent Michael Kitces. You go through everything, and you're a leader in this industry. You are a disruptor, and I think people need to educate themselves on the standard of care for financial planning. Right, Jackie?
Yeah, and we will drop that link in the show notes. But I want to say this. So as you know, I have my CFP, and really after this show, Bill, I think we need to get you your CFP too. but being a part of the industry, sometimes I'm not that proud of how it's represented. But there's other times where I'm thrilled that industry leaders and game changers like you and Abundo Wealth will come in and say, I think we can do this differently. And it's more focused on clients. The biggest question I get from people, especially people in the FI community, they know that I have my CFP and they'll say, well, it looks like advice only is the way to go because I don't want anyone to manage my investments. We're do-it-yourselfers here. And typically, if I refer them to someone that I know, they're filled up. It's overwhelmingly our industry. It's still the assets under management, but there are some unicorns like you and a few others. Nectarine is trying to do that. This advice only is the only one where they don't require you to move over your investment. So this space is kind of lonely. This space is not big enough. It's got a lot of room to grow. And I'm glad that you're at the forefront of that. So for our listeners, the financial planning industry does have a black mark for the way that they have been doing business for a very long time. That's no longer what it should look like, and the future looks very different, but it is slow going. So can you just give us like maybe the 5-minute version of like why you decided to go this model? It may not be the most lucrative. It may not have a lot of other firms that you could learn from, but you decided to do it. I guess tell us a little bit about some of the unique things that you do and a little bit about your business model, because I feel like a lot of our FI audience, this is the ones that want help. This is the type of help they want. They don't want that old model. Well,
before you do that, I just want to say that this is a great gift for Christmas. if you've got the bandwidth, or say you're retired and you want to give to your kids, this is a way to give generational wealth. This is a way to give generational education, and it's not emotional. My kids don't want to hear this from me. This is the financial literacy course in a way where you're actively doing this. You know how to manage your paycheck. You learn how to invest. You learn about all the multitude of aspects that go into financial planning that have nothing to do with the numbers. So I would encourage our older audience that have reached their number and want to help their kids or grandkids, consider giving the gift of a flat fee model, advice only model to your kids.
Yeah, and just one quick little clarification, Bill. Fee only, fee based on all of the things with fee in the name, they can still charge assets under management. And I think that's the big confusion. The only model where there is no assets under management, where they're not going to make you move your assets, is advice only. And I'm sure Eric can speak to that a lot better, but I'm trying to correct my language too, because I do say the fee only and all that all the time, but they can still be assets under management. So tell us a little more, Eric. We've gone on enough.
No, I also get so mixed up in all the terminology because there's fee only, fee based, fiduciary, blah, blah, blah. And yes, what Jackie is saying is absolutely correct. If you don't want to give up control of your investments and you like to keep them at Fidelity, or you like to keep them at Vanguard, you like to keep them at Schwab or wherever they're at, an advice only advisor will still work with you. They will help you with investment recommendations. They will help you with advice on everything in your financial life without requiring you to move that. So I think it's a pretty awesome thing, and I hope that it becomes the standard in our industry. And my brief history is I worked for a broker-dealer for 12 years, typical assets under management model. And it drove me nuts that somebody who had $1 million was paying 10 times more than somebody with $100,000. And 10 times more work was absolutely not being done for that person. And so that never made sense to me. And then I also saw that the percentage that was being charged was not enough to outperform the index. It was just every year, how would the assets under management do versus the index? And more often than not, the index won. So why was that fee being charged? And so that never made sense to me either. And I looked around the landscape and I thought, well, why isn't somebody doing it more similar to a lawyer where they're just charging for advice, right? Or a CPA. And shockingly, I didn't see anybody else that was doing it. It felt like a real missed opportunity. And so in 2019, I started with the idea of let's just charge a flat fee. Let's not require people to move their money. Let's just give them investment advice at wherever they're at. And this will save them a lot of money on fees. And this will actually empower them. They'll learn, they'll be educated. And yeah, it really immediately was a hit, if I could say that. I mean, people were like, yes, this is what I've been looking for.
Right.
This is what I wanted. And we have 11 financial planners on the team now, growing substantially. Our goal is to try to really make waves. And I've told the team, I think we can work with 20,000 people. There's plenty of demand for what we're doing. I know Jeremy and the Nectarine crew also sees the demand. And so, yeah, we want to try to change the industry and prove to other financial planners too, that like you can do right, you can do a good thing for consumers and still have a very good business.
Well, that's another thing I like. It's a friendly space. Nectarine and you are doing very similar things. They just basically have a platform where they got a lot of different advisors, and most of them are advice only. Some still are the fee model, but this space is so small that the people that are trying to lead the way are like, hey, I'm thinking like you're thinking. Let's make sure we're trying to get as big as we can. Because I think, I don't know if you know the number, but I'm sure it's like 80% plus of firms still have the assets under management model. And I'm not saying that's wrong or anything, but anyone that wants someone else to manage their investments, there's no shortage of firms that do that. There is a shortage of the advice only. I'm paying you a monthly fee, or I'm paying you a flat amount that has nothing to do with investments that I get to manage myself.
Well, I mean, this has been an illuminating hour. You're a busy guy. We know you need to move on with your day. We're going to have you back. There's so much more to talk about. And we love the unbiased advice. We love the Abundo model, and we're going to toot your horn just like we tooted Ally's horn. We love disruptors in the industry. You are approaching this as a doctor would a boutique practice where people have access to them with a monthly fee. Your fee model is very affordable. I think it's $189 a month. There's a front-end fee just to get into the group for the initial financial plan. We'll link to your firm in the show notes as well. We encourage people to explore your website. And then look for others that do this. We have to give a shout out to Sarah Catherine Gutierrez, who does this for physicians and is a leader in empowering women to take control of their money in particular. Jackie, any final thoughts?
Yeah, like you said, Eric, we are on board with you. We're glad that you are willing to be like one of the first few that is doing this advice only. The reason why we met you was through Chris Mamula, and we know him. He is a very important voice in the FIRE community that if he works for you, we know that that gives us the green light to at least start a conversation with you. And we're so glad with all your expertise that you were able to lend with us today. So thank you for that.
Well, thank you, Jackie. Yeah, thank you both for having me on. I really appreciate it. And yeah, Bill, you challenged me to continue to get better as an advisor. So thank you for that.
Oh, that's nice. I'm just an armchair advisor, you know.
He loves to say that.
This is not a financial advice. This is for entertainment and educational purposes only, especially for me. And I hope it's entertaining as well. But like I said, we're going to have him back. There's so many more topics to do. We're over 100 episodes and going strong. We're going to update our equipment. We're a little monetized to cover our costs too. And I appreciate your willingness to put up with the ads. But we love the ads from people that we trust and sponsor the show. Those are the ones that really are important to us. And Abundo has sponsored the show in all transparency. All right, guys, we are going to see you next week on Catching Up to FI.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. So our social media is Diana Falk. Our editor, Fritz Bassard, and show notes are done by Sarah von Sternberg. We love them and they keep us going.
Yeah, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you want to support the show and what we're doing, you can do that at Buy Me a Coffee, which is a platform that allows you to virtually say thank you if you get value from our content. The link is in the show notes, or you can head over to our website at catchinguptofy.com and click on the Support the Podcast tab at the top right. We hope you've enjoyed this episode of Catching Up to FI. We would appreciate it if you could leave us a 5-star review so that our message can reach others.
While we are financial educators, and I'm a financial professional that loves to teach, our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
We'll see you next time on Catching Up to FI.